20 million barrels of oil pass through a strait every day that is just 33 kilometers wide at its narrowest point, the Strait of Hormuz. 1/5 of the oil that keeps this world running squeezes through this single bottleneck every day. And this week, on some days, only 7 tankers made it through. 7. Just the week before that, the count was 16 a day. Please hold on to that second number for a moment, because it truly explains the entire context of this video. Currently, war risk insurance for a tanker passing through the Strait of Hormuz now costs between 3 to 10% of the ship's total value. Only about half a year ago, it was merely a tiny, insignificant fraction of a single percent. Now, a tanker worth a staggering $100 million in value is forced to pay anywhere from $3 to $10 million for a single trip, just to cover the cost of insurance. Those are 2 numbers, not an opinion. And from 2 such numbers, a chain is formed. A chain that runs from the bottleneck through freight rates and fertilizer all the way to your portfolio, and for some, even to the dinner table. Today, I'm doing something different from what you're hearing everywhere else, because everywhere right now, you're hearing the big words. Food prices are exploding, famine, crop failures. Some of that is true, but a large part of it is just scaremongering. And throughout the entire duration of this presentation, I'll show you, using one specific officially recognized data point, a FAO figure from the United Nations, exactly where serious analysis ends and alarmism begins. No conspiracy theories, no prepper stuff, and certainly no stockpiling of canned goods. We are simply focusing on the underlying structural mechanics of the system. This is the long cut. I'm taking the time to break this down completely, and I promise you by the end, you'll be able to do 2 things that most videos on this topic don't offer you. First, understand the chain itself, link by link, so that you can interpret the next headline on your own. And second, you will know 2 numbers that will allow you to track the further course of this crisis yourself without having to wait for some guru or for me. That's the outline for the next hour. First, where do we actually stand? How did we get here? The whole journey through time from the start of the war to today. Then what is really happening at the 2 choke points without exaggeration? Then the cascade, how this eats its way through freight, raw materials, and fertilizer, who it really affects and who it doesn't. The macro level inflation and the dilemma faced by central banks. 4 historical comparison cases, because we've experienced things like this before, and where this could be heading in 3 sober scenarios. And finally, the question that many of you are here for. What does this mean specifically for a hard asset portfolio with a shipping focus, for the positions that are at the heart of the whole thing for me? Authority instead of fear, mechanics instead of shouting. I would say, let's get started. Before we talk about freight rates and portfolios, we need to quickly go back, because if you don't know what happened in the last 5 months, you won't understand why Hormuz is even closed, and you'll fall for every half-baked headline. So let's go through the timeline step by step. Let's start at the beginning, February 28th, 2026. Within about 12 hours, the US and Israel carried out almost continuous strikes against Iran, targeting the missile program. The air defense, the leadership, the target was the nuclear and missile program. According to reports, the first wave killed the top Iranian leadership along with dozens of officials. The trigger was not a bolt from the blue. Nuclear diplomacy had collapsed. The old nuclear agreement was history, and since December 2025, there had been economic protests in Iran. Out of this mix, an open war emerged. The source here is the British Parliament's private briefing, Britannica. Iran is militarily inferior. US air power is clearly superior. So Iran resorted to the one lever it has, and that is geography. On March 4th, the Revolutionary Guard Navy declared the Strait of Hormuz closed. They boarded and fired upon merchant ships and laid sea mines. This is the core of the whole matter that you need to remember. Hormuz is Iran's asymmetric weapon. It cannot win the war in the air, but it can make the strait impassable or at least extremely dangerous. And with that, it holds half of the world's oil market hostage. On March 19th, the US launched an air campaign to reopen the strait. All the sources are definitely linked below as well. And now comes the pattern that continues to this day. Ceasefires that don't hold. On April 8th, a conditional ceasefire was declared. The first attempt at de-escalation, it didn't last. Then came the moment that is the most instructive for all of us as investors. The flash in the pan in June. On June 17th, the US and Iran signed a 14-point memorandum, the so-called Islamabad Memorandum, with a 60-day window. Trump and Pezeshkian and the oil market reacted immediately, minus 11% on the day of the announcement. Over the course of 4 trading days, Brent crude oil prices fell by a staggering $17 per barrel. Remember this image. That premium can completely vanish in just a few short days if a simple piece of paper is signed. We will come back to this in the capital scenario. But it was just a flash in the pan, not peace. Already on the June 19th, there was an Israel-Hezbollah ceasefire, and on June 20th, Iran closed the Strait of Hormuz again after Israel had struck targets in Lebanon. Take a look at this entire chain of events. A strike in Lebanon and the strait at the Persian Gulf is shut down. This is the regional interconnectedness that makes the whole situation so unstable. On June 27th, a time corridor was opened on the Omani side after a tanker named Kiko was hit and the US had once again attacked Iran. And then the relapse into July, which brings us to today. In the night leading up to the 6th of July, at least 2 rockets struck merchant ships. On the 7th of July, the Revolutionary Guards attacked a 3rd ship. 3 ships in 24 hours. With that, the memorandum, which was not even 3 weeks old, was practically broken. The US responded with shockwaves, including on July 11th and 15th, and disabled an empty tanker that was heading toward the Iranian island of Kag. Now comes the second thing, the new development, the 20th of July. On that day, the Houthis in Yemen imposed a maritime embargo against Saudi Arabia. The spokesman, Yahya Saraya, called it an eye for an eye. Retaliation for a Saudi attack on the airport in Sana'a. 2 tankers carrying Saudi crude oil promptly turned around in the Red Sea. I will go into the details of this embargo in the next chapter, because an important correction is attached to it. But for the timeline, what matters is, starting from the 20th of July, we no longer have just 1 choke point under fire, but a total of 2. And that brings us up to the time of recording. On July 22nd, or rather on July 21st, ships were once again hit in the Hormuz region. A supertanker under the Liberian flag, the Achilleus, a fuel tanker under the Maltese flag, the Karom Maleas, and the Kaifaren of the Kuwaiti oil tanker company northeast of Oman's Lima. Reported via the Responsible Maritime Trade Reporting Center, UKMTO. I am deliberately mentioning the ship names because this is not an abstract threat. These are concrete, verifiable events from this week. Apologies at this point if I mispronounce one or another name, but I think the whole video is, of course, meant to give you a rough macro and geopolitical overview. If I mispronounce a name here or there, I don't think it's particularly relevant. So here's a brief overview of the key players so you know who actually wants what. Because this is not a simple yes or no question. The US and Israel want 2 things: to destroy the nuclear and missile program and at the same time keep the strait open. Iran uses Hormuz as an asymmetric lever and, according to reports, is even trying to force ships onto Iranian routes and collect fees here. This explains why traffic isn't simply at 0 but rather restricted and expensive. The Houthis are putting pressure on Saudi Arabia and the Red Sea. And in between, Oman, Qatar, and Pakistan are mediating. And now for the honest part that the alarmists leave out. What we simply don't know for sure is whether Iran can ever physically close off Hormuz completely, or if this is just a war of attrition. Mines, targeted attacks, diversions, this is disputed, and the facts tend to argue against a total closure. After all, there are still 7 tankers a day passing through, not 0. A real full closure would also affect Iran's own exports via Karg Island. My interpretation of this, and I want to stress that this is only my assessment and not a prediction, is that closed still means restricted and dangerous to this day, not 0. And that's an important distinction when we talk about prices in a moment. And there's another uncertainty that needs to be honestly acknowledged. According to US intelligence services under the Nuclear Energy Authority, IAEA, the status of Iran's nuclear program is explicitly unclear. After the airstrikes, the IAEA withdrew its inspectors. Without access to the facilities in Natanz and Fordo, there is no confirmation of the current state of the program. The reported casualty figures from the Iranian Ministry of Health, there was talk of at least 17 dead and over 100 injured in a week of airstrikes. These have not been independently verified, so treat them for what they are, unconfirmed. Authority also means clearly stating what no one can know for sure. That's the current situation. Now let's talk about what this actually means for us. We have the story, now the hard facts from today, clearly sourced without dramatized numbers. First, Hormuz is practically closed, and by closed I mean measurably closed. Lloyd's List Intelligence, which is the authoritative maritime data source, counted in the week up to July 20th only 53 crossings through the strait. The week before, there were 157. That's 66% less in 7 days. And the number of tanker and gas carrier crossings alone has plummeted from 90 to 30. And to understand just how much is actually stuck, normally about 20% of global oil consumption passes through Hormuz. In 2024, that's an average of 20 million barrels per day. In the first half of 2025, it's even close to 21 million. 1/5 of the world's oil, plus around 20% of the global liquefied natural gas trade, LNG. Normally between 120 and 140 ships pass through this strait every day, about half of them tankers. And there are hardly any alternatives. Only about 2.5 million barrels per day can be rerouted via pipelines from Saudi Arabia and the Emirates to bypass the choke point. The rest has to go through there. Now, and this is important to me for the sake of honesty, it's reduced, not zero. Ships are still sailing. Since the 6th of July, at least 9 ships have been attacked because Iran is forcing ships into its territorial waters. But those who are still sailing are paying a brutal price. More on that in a moment. And that is the difference between a sober analysis and a doomsday headline. Here, closed means so dangerous and expensive that 2/3 of the traffic disappears. Not that not a single ship is left. Secondly, and this is what's really new, Bab al-Mandeb, the strait at the southern end of the Red Sea. And here I need to clear up a misconception that I've seen in a few headlines. It's not a Saudi Arabia embargo. The actor is exactly the other way around. It is the Houthis in Yemen who are imposing an embargo against Saudi Arabia. On July 20th, effective immediately, an eye for an eye. Retaliation for the attack on Sana'a airport. Announced by spokesman Yahya Sarrea. They want to close Bab al-Mandeb to Saudi shipping. Normally, about 12% of global trade passes through this strait. Anyone who tells you that Saudi Arabia is blocking has mixed up the actors. It's exactly the other way around in this case. And now the point why we're probably going to talk about this for a whole hour, the double blow, with Hormuz effectively closed. Since the end of February, closing Bab al-Mandeb on top of that could affect up to 25% of the global oil and gas supply. A quarter. Both major bottlenecks of the global economy are blocking each other at the same time. It has never happened this simultaneously before. I'm going to clear up one figure right away so we stay accurate. You sometimes read that a quarter of all container traffic goes through Bab al-Mandeb. I can't confirm this exact figure with 2 independent, reputable sources, so I won't state it as a fact. What is confirmed is 12% of global trade, and that around 10% of the world's container fleet already has to take the longer detour. That's more than enough to understand the mechanics. And that's exactly the difference I value on this channel. I won't throw out a dramatic number just because it sounds good. I'll tell you what is actually confirmed. Now, let's consider the significant economic costs of this blockade. And this serves as the primary transmission belt into the real economy, which we will examine in detail throughout the rest of this video. The war risk insurance that a ship pays for such a journey, the so-called war risk hull premium, has exploded. Before the war, before February, it was just a fraction of a percent. Roughly about 0.25% of the ship's value. At the peak in early March, it already jumped to 2.5 to 5%, and by mid-July, we're talking about 3 to 10% of the hull value. That's 12 to 40 times the pre-war level. I already calculated this in the hook or at the beginning. A tanker worth $100 million now pays $3 to $10 million per trip instead of around $250,000 before. And the crucial point for everything that follows, these costs end up in the freight rate and thus ultimately in the price of goods. And to put into perspective the scale we're dealing with, the International Energy Agency has described the disruption around Hormuz as the largest supply disruption in the history of the oil market. In March alone, the cumulative shortfall added up to over 360 million barrels. This is not a minor regional disruption. This is an event that will go down in the record books. Before we move on to the cascade, freight, fertilizer, food, an honest interjection so we don't slip into doomer mode. Everything I've just described to you is a supply and geopolitics shock, not a demand shock. And this will be important in a moment when we talk about central banks. And as I said, it's throttled and dangerous, not zero. The question of whether and when this will tip and in which direction we'll address thoroughly in the scenario chapter. First, let's follow the chain. How does such a bottleneck work its way through the real economy, from freight rates to fertilizer to some people's dinner tables? And that's exactly what we're going to look at now. All right, we've now seen what actually happened at the two bottlenecks. Hormuz is practically closed. Traffic has dropped by 2/3. The Houthi embargo in the Red Sea on top of that, and the economic cost for this comes in the form of insurance premiums, which have jumped from a fraction of a percent to double-digit millions per trip. That was the map. Now it gets specific because a choke point isn't just a red dot on a map. It eats its way through the real economy, and it does so in stages. I'm going to show you this chain, link by link, from the cargo to the fertilizer all the way to the dinner table. And very importantly, with a single number, I'll show you in a moment where serious analysis ends and where alarmism begins. And that's the honest part of the whole video. So stay tuned. Stage 1 is the cargo. If you can no longer safely travel through Hormuz and the Red Sea, you have to go around the Cape of Good Hope, down around Africa. That sounds trivial, but it's the lever for everything that follows. Such a Cape rerouting adds 10 to 15 extra transit days to an Asia-Europe journey and about 3,800 additional nautical miles. It's estimated that about 2.5 million TEU of container capacity are stuck because of this, and around 10% of the entire global container fleet has been displaced from the Gulf onto this longer route. And now the mechanics, which you really have to understand once because everything else depends on it. Longer routes mean more ton miles traveled. A ton mile is simply 1 ton of goods transported 1 nautical mile. If the same amount of goods suddenly has to travel much farther, the number of ton miles increases, even though not a single gram more is being transported. And because there aren't more ships overnight, you now need more shipping capacity for the same cargo. So the effectively available capacity decreases, even though not a single ship has been scrapped. Less effective capacity with the same demand, and the rate goes up. This isn't just my theory, that's simply how a freight market works. Remember the term ton mile, it will come up again later when we talk about the depot, because that's the real lever for returns. And what does that actually do to the freight rates? They go up. The Drewry World Container Index, which is the standard index for container freight and serves as a benchmark for half the industry, stood at $4,639 per 40-foot container on July 9th. That's the highest level since September 2024. But what's also interesting is what happened afterwards. By July 16th, it had cooled off slightly again, down 2% to $4,547. I'm telling you this deliberately because honesty is important. The freight market is not a one-way street going up, it breathes. but the level remains far above normal. So step 1 is checked off. Rerouting is driving up freight rates. Now step 2, and this is where it becomes relevant for the dinner table. Fertilizer is the link in the chain that most people skip over. Yet it's the most important one. About a third of the world's seaborne fertilizer trade passes through the Strait of Hormuz, roughly 16 million tons per year. A third. If this route gets blocked, fertilizer becomes scarcer and more expensive. And that's exactly what's happening. The World Bank projects an increase of more than 30% in the fertilizer price index by 2026. And the main driver, which the World Bank explicitly names, is the disruption of exports and precursor products through Hormuz. One particular subsegment stands out and it needs to be clearly separated, otherwise the numbers get mixed up. Urea, also known as nitrogen fertilizer, shot up to over $850 per ton in April, an increase of 80% since February. That's the highest level in 4 years. Careful, these are two different figures and I don't want you to mix them up. The plus 30% is the average index increase over the whole year, while the plus 80% is the peak value for urea from February to April. Both are documented, both by the World Bank. But they are not the same figure. Anyone who sells you fertilizer plus 86% as a single number has cherry-picked the worst spike. The reliable headline is plus 30% on average, with urea as the outlier on the high end. And now comes the number that separates the wheat from the chaff, literally. This is the moment when serious analysis separates from scaremongering. Because what would you logically expect now? Fertilizer up 30%, urea up 80%, so food prices should be exploding, right? Wrong. Look at this. The FAO Food Price Index, which is the global food price index of the United Nations and the standard measure for the world food situation, stood at 130.3 points in June 2026. That's 0.3% below May. It has dropped. It is almost 19% below the peak of March 2022, the Black Sea shock after the invasion of Ukraine. Let me take a moment to let that sink in, because that's the core of the whole thing. While headlines everywhere are talking about famine, the global food price index actually fell in June. And if you look closer, it gets even more nuanced. Grain actually dropped significantly in June, down 3.5%. Wheat alone is down 4.4%. Why? Because the Black Sea harvest has come in. It's simply the season. Vegetable oils are up 3.8%. Palm and rapeseed, rice is up 3.2%. So it's diverged. Some things are up, some are down. But it's not exploding. The claim that all food prices are skyrocketing is simply false as of June. Now, the crucial question, does this mean the whole fertilizer issue is just a storm in a teacup? No. And you need to listen carefully here because this is the real mechanism. The fertilizer effect is delayed. It doesn't show up at the supermarket checkout tomorrow. It moves through a chain with a built-in time lag. Expensive fertilizer today means less or lower quality input at the next sowing. Weaker yields in 1 or 2 quarters, and only then do grain prices rise. The sequence is fertilizer, then sowing, then harvest, not fertilizer, then immediately a shock on the shelves. Then an instant shock on the shelves. Several sources therefore say that the full effect on food prices won't be felt until 2027. One practical reason for this is that many farmers in 2026 were still able to rely on previously purchased fertilizer stocks. So the expensive bill comes later. And that's why both things are true at the same time. And that's the point I want you to take away. The FAO index is falling today, and yet the fertilizer warning is still justified. That's not a contradiction, it's simply the time lag in the chain. Anyone who tells you today that everything is exploding in the supermarket either has the wrong time frame or is simply selling you fear. And anyone who says it's not a big deal is ignoring the ticking time bomb in fertilizer. So the honest answer lies somewhere in between. Today, things are calm at the counter, but something is ticking in the production chain. I'm stating this clearly as my own assessment so you know where the facts end and my interpretation begins. I expect that this will gradually work its way into grain supply over Q3 and Q4 of this year, provided the disruption continues. The FAO chief economist put it exactly this way in the spring. The clock is ticking when it comes to fertilizer deliveries. Farmers who cannot afford or obtain nitrogen will produce with less input, and that could reduce yields. I emphasize the word could deliberately. This is not the 2027 harvest will fail situation. I hear statements like that in foolish circles, and they're not credible. The FAO says conditionally it could reduce yields. This is a probability, not a fate. And that's exactly how I treat it as well. By the way, FarmDoc, the Agricultural Economics Institute from Illinois, has measured the short-term grain response. So far, corn, wheat, and soybeans have moved moderately, up by 2 to 7.5%. Moderate, not catastrophic. That too is part of an honest assessment. Let's summarize the cascade before we move on. The choke point is jammed. Rerouting around the Cape means more ton miles, higher freight rates. Fury index over $4,600, and at the same time, a third of the potash fertilizer goes through Hormuz. Urea up 80%, index up 30%, and then the delayed transition. Fertilizer today, sowing, harvest, grain prices sometime in Q3, Q4, in some cases not until 2027. The FAO index is still calm today because the shock is on its way, not because it isn't coming. And that's the chain. And the interesting question now is, if this shock is on its way, who will it hit first? Because it doesn't hit everyone equally, and that's what we'll look at next, country by country. So let's talk honestly about who this chain affects, without doomsday talk, but also without sugarcoating. And I'm deliberately doing this geographically country by country because that's the part the sensationalist videos always skip. They shout, the world is starving. And the truth is, there is a very clear ranking of who gets hit first and hardest. And Germany, just to get that out of the way, is at the very end of this line. Let's start with the global number, but properly. The United Nations World Food Programme, or WFP, estimates that up to around 45 million additional people could fall into acute food insecurity. And now pay close attention to the if, because that's the whole difference. If the conflict continues beyond the second quarter and if the oil price stays above $100. This is a conditional number tied to certain conditions. The baseline from which these calculations are made is 318 million people who are already living in acute food insecurity at crisis level or worse, of whom around 41 million are in the emergency category. There are 13 designated hunger hotspots for the months of June to November 2026. The most severe are Sudan, South Sudan, Yemen, and Palestine. Acute famine risk in Sudan, South Sudan, Gaza, and Somalia. I emphasize this and use all these caveats because a different number is circulating online. 2 billion people are starving. That number is completely made up. It does not appear in any reputable source. The documented, honest figure is up to 45 million additional people conditionally. That is still bitter. For 45 million people, this is a catastrophe, but it is the truth and not 40 or 50 times that number. Just because a bigger number would fit better on a thumbnail. And one more point about discipline. This impact primarily affects already fragile countries. It does not affect German supermarkets. This is not downplaying the issue. This is precision. Now, regarding the ranking, and it follows a simple principle. How dependent is a country on imported grain that comes through the Bosporus? The higher the import dependency, the more direct the impact. At the top of the vulnerability list is Bangladesh. The country covers less than 10% of its wheat needs itself, with around 1.1 million tons of domestic production compared to over 7 million tons of demand. Over 85% has to be imported. In the 2025/2026 fiscal year, that's around 6.7 to 7.4 million tons. The government buffer stood at about 1.75 million tons in mid-2024. That is an extreme dependency. Densely populated, weak purchasing power, so there is high social explosive potential if bread prices rise. Bangladesh is the textbook example of how a freight and fertilizer shock on the other side of the world becomes a domestic political problem in South Asia. Then there's Egypt, and that's the prime example that everyone should know. Egypt is the world's largest wheat importer. Around 13 million tons of imports in the year 2025/2026, with a consumption of about 20.4 million tons. Domestic production of around 9.3 million tons covers only half. A good 45 to 50% comes from outside. And now comes the point why this is politically sensitive. The imported wheat is tied to the subsidized flatbread, the Aish Baladi, on which a large part of Egypt's more than 108 million people depend. The trend is heading toward 124 million by 2030. Bread and politics have been historically inseparable in Egypt. The strategic wheat reserve currently covers about 4 months, around 4.5 million tons, as of March 2026. However, the official goal of the purchasing authority GASC is 9 months. A 4-month buffer is a cushion, but it is far below what the country actually set as its security target. So there is a reserve, but at the same time there is vulnerability, both at once. Continuing on to North Africa, to the region known from the Arab Spring of 2011 as the breadbasket and center of power. Algeria imports around 75% of its wheat, Tunisia about 70%, and Morocco more than half of its grain. These are all countries where every extra dollar spent on freight and inputs has a direct impact on the state budget and social stability. But, and this is important to me because I don't want to slip into doomer mode here, there is also some relief. By 2026 or 2027, lower imports are expected in the region due to better domestic harvests. A decrease of 13% down to around 29 million tons. This is exactly the kind of nuance that's missing from the panic videos. Local harvests fluctuate, and a good harvest year can cushion some of the import pressure. It's not a monotonous decline. A special case that highlights vulnerability particularly sharply, Sub-Saharan Africa. The poorest countries in the world here have become most dependent on a single source of supply. Russia now accounts for around 32% of Africa's wheat imports. 20 years ago, it was 13%. As early as 2020, at least 15 African countries sourced more than half of their wheat from Russia or Ukraine. This is a vulnerability due to concentration. A single supplier dominates the supply for the poorest, and if their export routes or export policies become unstable, there are hardly any alternatives. This directly links the food supply chain to geopolitics. So, and now comes the other side of honesty, the counterexamples. They show that not the whole world is equally affected by hunger. First, Asia when it comes to rice. There, the situation is completely different from that of wheat. In the Middle East and Africa, Indonesia became self-sufficient in rice by 2025. A harvest of around 34.8 million tons, up by 13.5%, with a record reserve of about 4 million tons and a plan for 2026 to do entirely without rice imports. In 2025, India was the world's largest rice importer, with a net surplus of around $12 billion in this staple food. Rice makes up a large part of Asia's diet, making it significantly more resilient than the Middle East and Africa are with wheat. The exception in the region is the Philippines, which continues to run a net rice deficit of around $1.7 billion. But the general rule applies: the whole world is starving. That's not true. The situation varies greatly by region and by staple food. And now the part that directly concerns us here in Europe. Because Europe doesn't have a wheat problem, but a completely different one. Europe has a gas to fertilizer problem. And it's important to understand this because it brings the video from distant countries back into our own everyday reality. The connection runs through the chemistry that feeds half of humanity, the Haber-Bosch process, which is used to produce nitrogen fertilizer. And for Haber-Bosch, you need natural gas. Natural gas accounts for 70 to 80% of the variable costs in ammonia production. Ammonia is the precursor to nitrogen fertilizer. In plain terms, if the price of gas rises, the price of fertilizer almost automatically rises as well. And that's exactly what we're seeing. Nitrogen fertilizer prices in the EU in 2026 are about 71% higher than the level in 2024. In May, the EU Commission launched a fertilizer action plan, and European nitrogen production is operating at only about 75% of capacity. The rest simply isn't profitable at these gas prices. By the way, this isn't a new pattern, and that gives me reassurance for context rather than panic. We already saw exactly this in 2022. Back then, EU ammonia capacity was reduced by about 32% compared to the previous year due to the gas price shock. The price ratio of fertilizer to grain for European farmers in 2026 is at its weakest level since that year, 2022. So we know this playbook, and that helps put things into perspective. It is a familiar, recurring pattern, not an unprecedented state of emergency. And the trigger behind it takes us back to the beginning of the chain, to Hormuz. The Middle East accounts for almost a quarter of global urea exports, and a large portion of it passes through the Gulf corridor. If that gets blocked, the urea price rises, the more than 80% increase since February to over $850 per ton, which we are already familiar with. The World Bank Fertilizer Index is up more than 30% for 2026. But, and this is the most important counterpoint to doomsday scenarios, the World Bank explicitly expects fertilizer prices to ease again in 2027, once Middle Eastern exports return and gas costs decline. This is a cycle, not a permanent new normal. One last point about Europe to complete the picture. In terms of supply risk, Europe is in a much better position today than it was in 2022. The gas supply is now much more diversified. Liquefied natural gas, or LNG, now accounts for around 45% of EU gas imports. In 2024, Norway was the largest single supplier with about 1/3, and in the first quarter of 2026, the USA supplied around 57% of European LNG. The share of Russian pipeline gas has dropped from over 40% in 2021 to around 11% in 2024, so the volume risk has decreased. But, and this is the subtle distinction that must be honestly acknowledged, the price risk remains. Europe gets its gas, but it pays a globally competitive price for it. And through the Haber-Bosch process, this very price is reflected in fertilizer costs and thus potentially in the harvest. Supply is secured, but costs are not. And to conclude this regional overview, here's a point that shows that being affected is not just about poor importing countries, but also hits right in the middle of wealthy agricultural exporters, the United States. Around 70% of American farmers will no longer be able to fully afford the fertilizer they need by 2026. The additional costs in April were over $20 per acre compared to the previous year, and in some cases, up to $100,000 extra per farm in a single spring season. And the United States is a net exporter of agricultural goods. Nevertheless, the US agricultural sector is feeling the shock, and through exactly the same channel, input costs. Expensive fertilizer today means more expensive or scarcer harvests tomorrow. That brings us back full circle to the cascade from the last chapter. And it shows that this chain is truly global, from the farmer in Bangladesh to the farmer in the Midwest. So let's summarize. Those hit the hardest in the correct order are the wheat import dependent countries: Bangladesh, Egypt, North Africa, the fragile states south of the Sahara, where reliance on a single supplier increases vulnerability. Much more resilient are the rice-producing regions of Asia, like Indonesia and India and Europe, which is affected not through wheat, but through gas for fertilizer. The volume risk has decreased, but the price risk remains. And even the US agricultural sector is affected by input costs. What this means for the markets, for oil prices, for central banks, and ultimately for a solid investment portfolio, like for example in mines. We'll take a closer look at that right now, but remember one thing from this chapter. In the end, this is a distribution shock, not the end of the world. It is tangibly bitter for millions of people, but it is not an end of the world scenario. And precisely this distinction is the difference between analysis and fear-mongering. We have now seen who is affected first: the import-dependent countries, the baker in Egypt, the farmer in Bangladesh, and due to input costs, also the farmer in Iowa. But there is a level above all of this that affects every one of us, no matter where we live and whether we ever buy a ton of wheat: inflation. And this is exactly where this choke point shock becomes really interesting, because it puts central banks in a dilemma from which there is no clean way out. Let's start with the one sentence that carries this entire chapter. The oil shock we're experiencing here is a supply shock, not a demand shock. That might sound like splitting hairs, but it's the crucial difference, because if oil becomes more expensive because the global economy is booming and everyone needs more fuel, then that's a demand shock and a central bank knows exactly what to do. It slows down the economy a bit and the situation regulates itself. But here it's the other way around. Demand is not the problem. The problem is that 20% of the world's oil has to pass through a strait where there is currently shooting going on. Oil is becoming expensive because supply is constrained, not because the economy is overheating. And against a supply shock, a central bank doesn't have a good tool. Their interest rates can send small tankers through Hormuz. Their interest rates cannot send tankers through Hormuz. How much does oil actually affect inflation? There is a reliable rule of thumb from the International Monetary Fund, and it's important because it puts the reflex of oil up, everything explodes into a realistic perspective. The IMF calculates an oil price that is 10% higher for a year raises global headline inflation by about 0.4 percentage points, that is, 0.4, and reduces global economic output by 1 to 0.2%. And now you notice something, because it separates the serious from the unserious explanations. This rule is proportional. 10% more expensive oil for a year results in 0.4 percentage points more inflation. There is no reliable figure that says $10 more for Brent equals X points on the consumer price index. That number is circulating, but I'm not going to make it up here. The effect is real, but it's a matter of tenths, not the end of the world. And because that might sound a bit abstract globally, the Federal Reserve has actually calculated this specifically for the USA. The Dallas Fed, one of the regional central banks, published a working paper in April with a full model applied precisely to this Iran-Hormuz oil shock scenario for 2026. Result, headline inflation measured by the PCE rises by about 0.6 percentage points. Core inflation, meaning without the volatile energy and food prices, rises by only 0.2 percentage points. This is exactly the aha moment I want you to take away. The headline jumps 3 times as much as the core. In plain terms, the shock is almost entirely contained within oil itself, not in the broader price structure. And that's exactly why a central bank might be tempted to simply look through it, because they know the actual persistent core is hardly affected. By the way, the modeled oil prices in this calculation, depending on how long Hormuz remains closed, range from around $71 to $177 per barrel. And that's the range we're talking about here. And with that, we've reached the core of the chapter, the real dilemma. The IMF summed this up neatly in May. In the case of a supply shock, a central bank has exactly 2 options, and both are painful. Option 1, look through it. They tell themselves the oil price is a one-off surcharge. The core is hardly affected. If I now jack up interest rates, I'll be choking an economy that's already suffering from expensive oil. So I hold back and wait for the shock to pass through. Option 2, respond. They tell themselves if I hold back and people get used to high prices, then that becomes anchored in their expectations. The unions demand higher wages, companies raise their prices, and the one-off oil shock turns into second-round effects. A wage price spiral. To prevent that, I raise interest rates, even though the economy actually needs the opposite. And that's the dilemma. Letting it run risks unanchored expectations. Reacting risks stifling an already weak economy. There is no way out without a price. And now it gets really interesting because we don't have to discuss this in theory. We're seeing it live right now with 2 central banks that have chosen opposite options, Fed versus ECB. Let's start with Europe because the ECB chose to react. On June 11th, it raised interest rates by 25 basis points. The deposit rate is now at 2.25%, and that's remarkable because it's the first rate hike since September 2023. The ECB raised interest rates right in the middle of the supply shock, and on the same day, it raised its inflation forecast for 2026 from 2.6 to a full 3%. So in plain terms, they're saying we see inflation coming, we don't trust that it will pass through, we're taking action. And that's the textbook reaction to the fear of second-round effects. Do we also see this in the actual data? Yes, euro area inflation cooled down to 2.8% in June from 3.2% in May. So the overall figure is falling. But take a look at the energy component. In June, it was still at plus 8.5%. In May, it was even plus 10.8%. The energy price is the one sub-index that towers far above everything else. That's exactly where the shock lies in the official figures. Overall inflation is cooling down, but energy is burning hot. And now let's look across the Atlantic because the Fed is doing the exact opposite. In the US, headline inflation was at 3.5% in June and 4.2% in May. That was the highest value since April 2023. The drop from 4.2 to 3.5 was the sharpest monthly decline since April 2020, driven by falling energy prices during the reporting period. Core inflation stands at 2.6, and the market is pricing in an 88% probability of a rate pause at the next Fed meeting. So the Fed is looking through high but falling inflation, a volatile energy price, and a core that is behaving. So it is holding steady and waiting. Fed looks through, ECB reacts. The same dilemma, two opposite responses in real time. Why are the two deciding so differently? A big part of the answer is gas, and that is the bridge to the most uncomfortable part of this chapter. There is, in fact, an important difference between an oil shock and a gas shock, which central banks are very well aware of. An oil shock is immediate but short-lived. Gas station prices adjust within weeks, and then the effect is over. A gas shock is something else. It is broader and significantly more persistent. Gas seeps gradually and persistently into core inflation because it is present in so many areas. For example, heating, industrial processes, and as we saw in Chapter 3, fertilizer. And Europe is much more vulnerable to gas than the USA. That's why the ECB is more nervous. And here comes a figure that worries me for the winter. Soberly, without panic, but it needs to be put on the table. European gas storage facilities were at around 53% in mid to late July. That is the lowest level for this year, for this time of year in 5 years. About 15 percentage points below the 5-year average. Storage is filled in the summer to heat in the winter, and this year, Europe is lagging behind. The official storage target was lowered from 90 to 80%, and since April, injections have covered only about 40% of what is needed for the winter. You can also see it in the price. The Dutch gas price, the TTF, which is the European gas benchmark, closed at around 55 euros per megawatt hour on July 16th, the highest level since the end of March, and that's despite ongoing injections. Analysts say that prices may even have to go higher, so that Europeans, or Europe as a whole, can attract enough gas in the bidding competition with Asian energy demand. That's not my prediction. That's the interpretation of market observers. But the mechanics behind it are real. Tight storage, lagging replenishment, and global competition for the same liquefied gas. And because in the end, a portfolio always asks the question, and where do I take cover? We have to talk about gold, but honestly, not as a gold evangelist. The structural demand is real, and it doesn't come from doomsday savers, but from the central banks themselves. In the first quarter, they bought a net 244 tons of gold. That's the fastest pace in over a year, and that's despite record prices. The World Gold Council expects around 850 tons for the entire year, and in 2025, the central banks increased their holdings by over 700 tons, the largest annual increase since 1967. States are diversifying out of the dollar in a very matter-of-fact way. By the way, the all-time high for gold was $5,589 per ounce, reached at the end of January this year. But, and this is important to me, otherwise I'd be exactly the kind of gold bug I don't want to be. Gold doesn't rise in a straight line. Two forces are pulling on it at the same time. On the one hand, gold is a safe haven in times of geopolitical tension and negative real interest rates. When inflation eats up interest, suddenly interest-free gold becomes attractive. And on the other hand, gold faces headwinds. When bond yields rise because you can earn something on fixed income securities again, and when the dollar strengthens because a central bank turns hawkish and keeps interest rates high. Both forces are at work simultaneously in this situation. That's why gold is volatile here, not a one-way street going up. Anyone who sells the idea of oil up, therefore gold up, therefore bonds down as an automatic rule is oversimplifying things. It's a tug of war. And in a world where bonds are devalued in real terms by inflation, gold often fills exactly this gap in a portfolio. That's my assessment, and of course not a buy recommendation. If I sum up this entire macro chapter in one picture, we have a supply-side oil shock, growth dampened as a result, and interest rates that either remain pinned down or even rise. That's the ingredient list for a stagflation setup. High prices with weak growth. Historically, this is one of the most difficult environments ever for a central bank because its tools work against each other. What combats inflation exacerbates the weakness, and what alleviates the weakness fuels inflation. I'm deliberately not saying that we are definitely heading into stagflation. That would be a prediction that no one could seriously make for me. But the ingredients are on the table, and the one thing that has held up relatively well in previous stagflation phases was hard assets. Energy, raw materials, gold, and that's my assessment. I promise, and that's exactly why, for me, this entire video ultimately leads to a hard assets portfolio. But before we ask ourselves where things are heading, let's pause for a moment and look back, because this is not the first choke point shock in history. We have 4 of them well documented, and they tell us more about today, much more than any forecast could. I like history as an anchor, not as a prophecy. The 4 cases I'm about to show you aren't templates you can simply lay over 2026 to read off what's going to happen, but they do show you the pattern and where this time is truly different. In the end, I draw a common lesson that will add more value to your portfolio than any price target bet. Case 1, the forefather of all energy shocks, the oil embargo of 1973. In October 1973, OPEC imposed an embargo. This was in response to the West supporting Israel in the Yom Kippur War. And what happened to the oil price afterward remains the most famous energy shock figure in history to this day. Crude oil jumped from around $2.90 per barrel to $11.65 by January 1974, a 4-fold increase plus 387%. The OPEC average went from $1.82 in 1972 to around $11 in 1974. And what followed was textbook stagflation. Exactly the word we were just talking about. US consumer price inflation climbed to 12.3% in 1974, the highest post-war level up to that point. And listen, I'm deliberately saying 12.3 and not 11 because 11% is often mentioned, but the official figure from the US Statistics Agency is 12.3. After that, just under 7% in 1975, then below 5 in 1976. And for us investors, the most relevant consequence, this oil shock triggered the bear market of 1973 to 1974. The S&P 500 lost around 48% at its peak, and the Dow about 45% from the high in January 1973 to the low in December 1974. It was one of the most severe crashes since the Great Depression, accompanied by a recession. Remember this, an energy shock that comes from a choke point situation can have a deep impact on the stock markets. And that's the reason why, as investors, we need to take this topic seriously and not just consume it as news. Case 2, and now we're jumping from oil to food. The food crisis of 2007 to 2008 is particularly instructive for our cascade theme from chapter 3. Between January 2004 and May 2008, rice increased by 224%, wheat by 108%, and corn by 89%. And in the hot phase from January to May 2008, rice went from around $300 to about $1,200 per ton, a 300% increase in 4 months. But now, the point that really matters and is a direct parallel to today, this 2008 crisis was not a supply collapse. The fields were not empty. What made the price explode were export bans. India and Vietnam closed their borders, and panic buying, for example, by the Philippines, it was politics and psychology that drove the price up 300%, not a physical shortage. The FAO Food Price Index reached a record at the time in June 2008 with around 213 points. There were calls for help from 36 countries and unrest from Haiti to Egypt to Cameroon. Case 3 shows where such a price shock can lead politically. The Arab Spring in 2010 and 2011. In the summer of 2010, a drought destroyed about a third of Russia's wheat harvest. Russia imposed an export ban, and the FAO index climbed to 238 points by February 2011. At the time, this was an all-time high. Wheat became up to 84% more expensive. Egypt, which imports 45 to 55% of its wheat, came under pressure, and shortly thereafter, the region tipped politically. But now comes the honest part, and I say this very deliberately. The connection between rising wheat prices and the Arab Spring is documented, but it is not monocausal. The Director General of an agricultural research institute definitely named prices as one of the causes. Some of the researchers have even identified a price threshold above which unrest becomes more frequent. But the wheat price was an amplifier alongside political and structural factors, not the sole trigger. And that is my clear assessment. Anyone who tells you that expensive bread alone toppled governments is exaggerating the causality. You have to be that precise, otherwise analysis turns into alarmism. Case 4, the most recent and well-known, and the direct bridge to today, the Black Sea shock of 2022. After the Russian invasion of Ukraine, the FAO index jumped to 159.7 points in March 2022, a new all-time high. Russia and Ukraine together account for around 30% of global wheat exports and about 20% of corn exports. The Black Sea itself is a choke point. The FAO wheat index alone jumped by almost 20% in March. And it didn't stop with wheat. The World Bank fertilizer index climbed to an all-time high in 2022. Almost a doubling. Chicago wheat rose from around $7.58 to $12.94 per bushel. A monthly jump of about 30%, historically comparable only to the Dust Bowl of the 1930s and to 1972. So exactly the double pattern we fear today, fertilizer and grain at the same time. And now a quick interjection that I have to make as a serious explainer, otherwise I would be misleading you. You just heard about two FAO records, 238 in February 2011 and 159.7 in March 2022. You must absolutely not compare them directly and say that 2011 was much worse. Why? Because the FAO changed the base year of its index in the meantime. The 238 is based on the old base, while the 159.7 is based on the new one. On the new comparable basis, February 2022 was already above the unadjusted February 2011. So 2022 has surpassed 2011. But the raw numbers, 238 versus 159.7, say the opposite because they use different scales. I'm showing you this in such detail because that's the difference between someone who throws a dramatic number at you and someone who tells you what it really means. And now, the most important part of the story. The reason why I'm not a doomer, part of 2022 was diffused through diplomacy. The UN, and Turkey brokered the Black Sea Grain Initiative in July 2022. Ukrainian sea exports resumed, and in the year after the March peak, the FAO index fell by more than 23%. That's the lesson you need to take away. Choke point shocks are not permanent. Diplomacy, rerouting, and supply response push prices back down over time. Panic is rarely a good advisor when history shows that these spikes subside. So now the question you've been asking yourself all along, is 2026 like 1973? And my honest answer is, the parallel is instructive, but structurally it's a different animal. In 1973, there was a suitable multinational bloc, OPEC, which deliberately acted against the West and removed about 4.5 million barrels per day, around 7% of the world's supply, from the market. That was a coordinated political weapon wielded by an entire cartel. 2026 is something different. Here, at its core, it is a single actor at a single transit point. Not a suitable bloc turning off the tap, but rather a war of attrition at a strait. And another difference that is often overlooked, the vulnerability has shifted. In 1973, the oil shock primarily affected the Western industrialized nations. Today, a large portion of the oil flows through Hormuz to Asia. The dependency has shifted from the Western to the Asian economies. Anyone who mechanically says today that this will be like 1973 S&P minus 48% is ignoring the fact that the structure of the shock is completely different. That is my assessment. The analogy serves as a warning, not as a template to copy. And if I lay all four cases on top of each other, one lesson emerges. It is more powerful than any single figure and tells you more about today than any forecast. In all four episodes, it was not the pure physical supply disruption that had the strongest effect. It was the political and psychological amplification. 1973, the cartel embargo. 2008, the travel export bans. 2010, the Russian wheat hold. 2022, the invasion plus panic. Everywhere, the choke point or the disruption was only the trigger. The real multiplier was politics and expectations. Export bans, hoarding, panic buying. The trigger is geography, quantity, the harvest. That's what gets stuck. The bomb is the human reaction to it. And that's exactly why in this video, I draw such a hard line between the documented numbers and the panic mongering. Because if history teaches us anything, it's that these expectations themselves become a driver of prices. Staying calm and doing the math is not only the decent attitude, it's the analytically correct one. So now we have the map and the lessons from the past. The question that really concerns us remains, where is this crisis headed from here? De-escalation, stalemate, or escalation? And how can you tell which path is currently unfolding without anyone having to sell you a probability? That's exactly what we're going to look at next. From history, we learn one thing. Now the obvious question, where is all this heading? And here I have to disappoint you if you're expecting a percentage bet. I'm not going to give you a number like 58% probability of escalation. Such numbers are made up no matter who says them. What I'm giving you today are 3 plausible paths: de-escalation, stalemate, escalation, each with the specific trigger that lets you recognize which one is currently happening. And at the very end, I'll give you the 2 numbers you can use to track this yourself without having to listen to any analyst. The starting point for our live anchor Brent is currently at $94, 91 plus a good 4% on the day. WTI at $88, both have jumped after there were renewed US airstrikes and another tanker was hit. This is not a forecast price. This is the measured price from this morning. Remember this number. We'll come back to it in every scenario. Scenario A, de-escalation. The best case, and I am deliberately starting with it because it is the most honest damper against any doomer reflex. Look at what happened in June. After the memorandum from the 17th and 18th of June, the risk premium didn't fall over weeks, but in days. Brent dropped from the war peak of around $120 at the end of April to an average of $85 in June and was briefly below $70 on July 1st. That was exactly the pre-war level from the end of February. And then with the de-escalation, it went back up just as quickly to just under 95, where we are today. The key point you need to remember, last time the price was back to pre-war levels within 2 weeks, and 3 weeks later it was up again. Things can move that quickly in both directions. What would be the specific trigger for scenario A? A ceasefire in the strait, a standstill plus a concrete reopening of the strait. And that's not wishful thinking. On July 21st, regional mediators presented Washington and Tehran with a 10-day ceasefire proposal intended to reactivate the June memorandum. ING is holding out some hope for de-escalation. This is a real substantiated trigger for de-escalation, not just a straw to grasp at. And how can you spot the turning point before the headline hits? 3 indicators, all public. First, shipping transits, which immediately increased again in June after the memorandum. That was the early warning signal. Second, war risk premiums in hull insurance dropped after the memorandum and jumped back up after the 3 tanker attacks. The head of the Marine Insurers Association summed it up dryly. The war risk rates moved as the risk moved. And third, the Brent spot price, which reacts the fastest of all. When transits rise, premiums fall. If Brent follows, then scenario A is playing out. Scenario B, the stalemate. The most likely, most boring, and in practice often underestimated part. It neither opens up nor closes completely. It wears itself down, and here too, a stalemate does not mean endlessly rising prices. The American Energy Agency IAM expects that the price increase will be dampened by declining demand. In 2026, around 1.1 million barrels per day less will be in demand than in 2025, simply because high prices destroy demand. The IAM model sees Brent at around $105 in June and July, with a lower base in the 4th quarter. If Middle East production returns, demand destruction plus the OPEC buffer will take effect, in other words, counteracting the doomer scenario. But on the fertilizer side, the stalemate is a ticking clock. The World Bank Fertilizer Index was over 12% higher in the 1st quarter of 2026, highest level since October 2022. Urea up 28% in 3 weeks and 80% from February to April to over $850 per ton. The 2026 projection is up 31%, driven by around 60% urea. But, and this is crucial, conditionally, if the disruption continues, a third of the world's fertilizer passes through the strait, the stalemate remains. This shock could creep from the next sowing season into the 2026 and 2027 harvests. And here comes the proof that I don't want to make you panic. The credibility moment, the FAO World Food Price Index even dropped slightly in June to 130.3 points, down 0.3% compared to May. You already know this number from the Cascade chapter, but here it serves as the argument against panic. Grains down 3.5%, global wheat down 4.4% thanks to the Black Sea harvest. All food prices are exploding. This simply wasn't true as of June. The movement is nuanced. Vegetable oils and meat up, grains, sugar, and dairy down. If someone tells you otherwise, they either haven't read the numbers or they're trying to sell you fear. But the FAO does issue an honest warning, and that's my assessment, not a certainty. If the disruption lasts 3 months or more, planting decisions from 2026 onward will be affected because farmers who can't afford the expensive nitrogen will produce with less input. And that could lower the yields of crops that require a lot of fertilizer. Wheat, rice, corn. So far, the short-term reactions in grain prices have been moderate, up by 2 to 7.5%. So the shock on the shelves hasn't happened yet, but there's already something real happening in the soil. Scenario C, escalation, the worst case scenario. And I'll discuss this in a disciplined way because this is where most people lose their grip on reality. What do the big firms say? Goldman Sachs models that with more than a month of severely restricted traffic, Brent would average around $120 in the third quarter and $115 in the fourth quarter. JP Morgan sees $120 to $130 if it lasts through the third quarter, and in the absolute worst case, a move toward $150 within a month after a full closure. But, and this number always needs to be mentioned alongside, otherwise I'd just be fear-mongering here, Goldman's base case in the event of de-escalation remains at around $80 in the fourth quarter. These are institutional scenarios with conditions, not made-up probabilities. The trigger for C is already underway in its early stages. Since July 6th, at least 9 ships have been attacked. Iran is forcing tankers into its territorial waters. The head of a maritime risk insight firm is already calling the situation a worst-case scenario. The real escalation switch would be a formal declaration of closure by Iran. That has already happened before during the course of the war. This is a matter of record, not a conspiracy. And scenario C has a second channel that hits Europe directly. Gas. Around 20% of the world's liquefied gas passes through Hormuz, 93% of Qatar's exports, and 96% of the Emirates. A real closure would hit gas just as hard as oil. At the peak of the war, European gas prices jumped by 50 to 75%. And because Gulf gas is the raw material for nitrogen fertilizer, this brings the story full circle. An LNG disruption exacerbates the shortage of urea and ammonia, hitting fertilizer-dependent importing countries like India, Pakistan, Bangladesh, and large parts of Africa. The World Bank puts it plainly, the poorest are hit the hardest. No price forecast, just a statement about distribution. And now the dashboard, the important part of this chapter. You don't need a forecast, you need 2 numbers, and both are public. Number 1, the throughput through Hormuz, oil and petroleum products, was around 30% lower in the first quarter compared to the previous year, at 14.6 million barrels per day, down from the usual 20.4. The vessel transits in the week up to July 20th were only 53, a decrease of 66% compared to 157. If the number rises again, scenario A is in play. If it remains low, it's a stalemate. If it collapses towards 0, that's escalation. Number 2, the war risk premium on the ship's hull. From fractions of a percent before February to around 5% of the ship's value, which is now the new market norm. Individual voyages are in the double digits, amounting to millions. If it falls, it's A. If it stays high sideways, it's B. If it jumps, it's C. Those are your 2 instruments, throughput and premium. Everything else is just reading tea leaves. That's all for that thread. Now, the question some of you have been waiting for throughout the entire video. If the thesis holds, who profits from it and what do you pay for it? I'll illustrate this with specific stocks and I'll tell you right up front. To keep things transparent, the stocks I mark as my positions are ones I personally hold publicly, either through Trade Republic or Scalable. Every assessment is my personal opinion, my thesis, not investment advice. The full disclaimer will be at the end here. I also regularly make portfolio update videos, so feel free to check those out as well. My entire portfolio is transparently public for everyone, either on Scalable or Trade Republic. There's an update here every month. And there's one thing I want to emphasize up front because it overrides everything. The most important figures in this chapter, the valuations, are based on peak rates. If you look at the trailing PE ratio for a tanker and it says 8 or 9, you might think it's dirt cheap. That's the trap. These profits were generated at a choke point peak, war risk premiums that jumped from 12 to 40 times their usual levels. VLCC spot rates peaks of over $420,000 a day back then in March. If you recalculate that based on normalized analyst estimates for 2027 and 2028, that PE of 8 turns into 12 or 14, sometimes even 16. The stock was never cheap. It only looked cheap as long as the war kept rates high. And if things de-escalate in Hormuz, that exact premium is the first to disappear. Keep that in mind with every name. What I want to briefly mention here, I buy counter-cyclically. That means I bought shipping stocks when nobody wanted them, when prices were still at rock bottom at their 52-week lows. Just a quick note for context. Let's start with the core and the pure tanker and gas names that I personally hold. These are 4 core positions. CMB.Tech is currently my largest position. At the moment, it's trading at $15.60. My thesis, rather cheap. It has the most stable forward profile in the entire basket because the diversified crude tanker plus dry bulk plus the hydrogen new build program cushions the peak collapse that pure VLCC players are risking. Honest catch, the free cash flow is negative because the new build program is eating up cash and the dividend yield at 5.7% is the lowest in the basket. But here too, because they are focusing on long-term, on long-term rates in the end, and are currently still in a kind of build-up phase and simply investing a lot. That was the keyword I was missing. Less leverage on rates, but more substance. By the way, the specific reported quarterly figures from CMB.Tech. It was a record quarter driven by tanker volatility around Hormuz, with VLCC rates well above the long-term average. Dorian LPG at around $44. Thesis fair, solid, but not cheap because the price is close to the 42-week high. What I like here, the real cash flow plus a 10% free cash flow yield, the best among the gas names. That provides a real downside buffer. Dorian is indirectly leveraged, and this is LPG, not pipelines. But the longer ton miles and the fertilizer shortage play directly into the gas carrier rates. Torn at around $30. Thesis fair. And here you see the cyclicality trap in its purest form. EV/EBIT day of 6.2, the cheapest in the basket. A P/E ratio of 8.7 looks dirt cheap, but based on the 2028 estimate, the P/E almost doubles to 13. The safety net is the lowest price to book ratio in the basket at 1.34. Here, the intrinsic value is closest to a pure product tanker. The most direct Red Sea plus Hormuz double beneficiary and the only clear buy consensus. And now it gets honestly uncomfortable. Flex LNG, around $31, also one of my picks, but the thesis holds up the worst here. My assessment, rather expensive. The most expensive profile in the basket, PE of 22. The dividend of 9.6% sounds hefty, but current earnings only cover 4.5% of that. The payout does not come cleanly from ongoing profits. The core of Flex operates an almost fully time-chartered fleet with hardly any spot exposure. However, the choke point is driving up spot rates. A fixed-term fleet hardly benefits from that. The analyst price target is actually below the current price. I hold the stock, but as a choke point bet, it's currently the weakest fit. That definitely needs to be said. What I want to say here is I want to present all my shipping stocks again soon. Well, I've already introduced them. There was also a brief complete update on how they've developed over the years. I've held them since then, but I definitely want to analyze all the shipping stocks for you again, including all the complete figures. Exactly. So this statement and my assessment that I've already mentioned are definitely justified. But the complete analysis is definitely still coming because many shipping stocks, when they earn high spot rates, also pay out those spot rates. And then things can look different, especially if you calculate it differently, for example, based on free cash flow and so on. Exactly, just a quick note on that here. And because I don't want any confirmation bias in the tanker universe, There are also the more aggressive bets like Frontline, International Seaways, Oceanus, and Nordic American. They are the textbook example of what I warn against. Frontline is the most direct VLCC player out there, and that's exactly where the only real sell ratings in the entire sector are found. 4 of them, a price-to-book ratio of 3, means there's no intrinsic value floor if rates drop. International Seaways is trading almost at its 52-week high with a net margin of 55%. That's not a seal of quality, that's a pure peak signal, and Nordic American is the value trap. A PE ratio of 25, the weakest margins in the sector. The analysts see almost 50% downside. Remember, as a case study, exposure to the choke point doesn't automatically mean the company can turn that into cash flow. And besides, we also want to buy when nobody wants the shares, and that's definitely not the case at the moment. Second section, the bridge back to the fertilizer cascade. Because even the best macro thesis is useless if you can't make it investable. With fertilizer, you can do that through Nutrien at around $67. My thesis, relatively cheap and the cleanest direct beneficiary of the entire cascade. Do you remember? A third of the world's fertilizer passes through Hormuz, urea plus 80%. Nutrien is the world's largest potash producer and a major nitrogen player in North America. If the choke point hits the Near East, urea exports, and the gas shock shuts down the Egyptian plants, North America benefits from the price spread. And the crucial difference compared to the tankers, this is not a classic cyclical trap. Nutrien is low cost, earned money even in the weak environment from 2023 to 2025 and has consistently covered its dividend. Payout only 44%, the most elegant way to play the fertilizer cascade without the full tanker tail risk. The honest contrast to this, ADM, that is Archer Daniels Midland at $86. I mention it because it is often lumped together as an agricultural beneficiary, and that's incorrect. My thesis, rather expensive and the wrong fit. ADM is a processor. Oilseeds, ethanol, not a fertilizer producer. Higher fertilizer prices are not a tailwind for ADM's input costs. The stock is at a 52-week high. The trailing PE ratio of 39 is based on peak earnings. You don't buy a stock like this based on that thesis. And finally, 2 baskets that I deliberately grouped together. First, the oil producers, the Brent beta stocks, Equinor, Petrobras, VR Energy, Woodside Energy. These are not choke point beneficiaries in the strict sense. They only benefit if the shock drives up the global Brent price. It's a price beta, not a logistics lever. Norwegian oil and gas flow to Europe via pipeline, completely bypassing the choke points. Petrobras and VR are rather cheap, but come with significant political or debt risk. Equinor and Woodside are fairly to slightly expensive. Equipetrol and Energean are rather expensive to the point of being a no-go. Energean is actually the opposite of a beneficiary. Their Israeli gas fields are an operational risk in the conflict, not a source of profit. As a group, yes, they're a cheap Brent beta, but definitely not a pure choke point play. Second basket, container and dry bulk. The TK tankers, Zim, Starbulk, Jinko, Diana, Himalaya. Only one is a true direct beneficiary, and that's TK tankers. Product and scrap tankers are especially leveraged. For me, it's the strongest in the baskets, but again with the same peak warning, a PE ratio of 6 at peak earnings. Zim benefits partially from Red Sea rerouting, but is being crushed by the oversupply of new builds. The street is projecting a 30% drop, and the entire dry bulk block is transporting iron ore and coal to China, not through Hormuz or the Red Sea. The Cape rerouting argument sounds good, but it doesn't hold right now because the Baltic Dry Index is falling. By the way, the same honesty applies to my own portfolio. Not every one of my positions is automatically a beneficiary. For example, my coal position is trading below its average because it suffers more from the higher freight costs of the longer detours than it benefits from the choke point. If I sum this up, the thesis is most cleanly investable through pure tanker and product tanker names and through Nutrien on the fertilizer side. But, and I repeat this deliberately because that's the whole point, the cheap-looking multiples are peak multiples. I'm not buying a bargain here. I'm buying into a cycle with geopolitical tail risk. How I handle this concretely, I'll explain now at the end. And now to the last question, soberly without any prepper nonsense. No, I'm not telling you to buy gold and hoard canned goods. That's not my style. I'll tell you how I assess a situation like this. First, burn risk premium from a structural cycle. Part of what you're seeing right now with Brent and tanker rates is a geopolitical premium that can disappear in 2 days, like it did in June. The other part is a structural cycle, few new builds, an aging fleet, high tonnage, and strong marine demand. That remains even if a choke point opens up. At this point as well, I've already made a detailed video about the shipping cycle. On the one hand, the shipping cycle is coming to an end, and on the other, there's the ESG reform in shipping. There are also some very interesting aspects to that. My core question with every shipping position, am I just buying the headline right now or a company that also makes money at normalized rates? The premium is the icing on the cake, not the thesis. Both position size and volatility. Shipping is cyclical and highly volatile. Just look at the 52-week range of CMB.Tech from $7.78 to $17.72. That's not something you put half your portfolio into and sleep soundly at night. This is a position size so that you can withstand a 30% pullback without getting nervous. And third, diversification precisely against that tail risk. If half of your thesis remains the choke point, then you also need something in your portfolio that wins if it opens up. A portfolio that's just a single geopolitical bet isn't a portfolio, it's leverage on Hormuz. And since we've just been talking about the big macro situation, here is my overall assessment, clearly stated as my thesis with a risk disclaimer. What we're seeing here has all the ingredients of a stagflation setup, a supply-side oil shock, dampened growth, and interest rates that are stuck or even rising. Historically, this is one of the most difficult monetary policy environments because the tools work against each other. And in previous stagflation phases, hard assets like energy, commodities, and gold were relative outperformers. This is not a price target nor a percentage bet. This is the reason why I have been building my portfolio around exactly this axis for years. But it remains a thesis and geopolitics can tip it in either direction. Of course, I also built it this way because it naturally serves as an inflation hedge. And for me, it's simply something with substance that no one can take away from you. What exactly am I watching in the coming days? Precisely the two figures from the dashboard. First, the Hormuz throughput and the weekly transit. Does the traffic remain low or does it recover? Second, the war risk premium on shipping routes. Does it move sideways or does it spike? And third, keep the fertilizer cycle in mind, because that's where it will be decided whether the food cascade from chapter 3 actually materializes in quarter 3 and quarter 4 or dissolves. And to be honest, so no one leaves here with the wrong impression, closed at Hormuz so far means restricted and dangerous, not zero. On some days, the flow is reduced to just a handful of tankers, but it still flows. A permanent total blockade would also affect Iran's own exports via Kark Island, which argues against a complete closure. Diplomacy is fragile. Several deals have been signed and all have been broken, and the big unknown remains the status of Iran's nuclear program. Because according to the IAEA and US analysts, no one knows for sure since the inspectors were withdrawn. That is the honest map. 2 choke points, a chain from the bottleneck through the cargo and fertilizer all the way to your depot, and for some, onto the dinner table. With mechanics instead of fear, and with the clear admission that geopolitics can tip in either direction. If this sober way of working through a topic was helpful to you, please let me know. That helps the channel more than any subscription battle. Next week, I'll take a look at how tanker rates have developed after the weekend. So essentially a weekly review where I also cover the most important news about the stocks I hold, or generally from a macro perspective and what that specifically means for gas carriers. Until then, of course, this was not investment advice. All content is intended solely for information and entertainment purposes. I have disclosed my personal opinion and my own position. This is not a recommendation to buy or sell anything. Do your own research and act on your own responsibility. I would say until then, see you in the next video. Take care of yourselves and your capital. Until then, invest successfully.